On one hand, you have a property's capitalization rate, or cap rate for short.
Right, that's the expected annual rate of return on a real estate investment, considering its net income and market value.
Exactly. Then, on the other hand, you have the current yield on a 10-year U.S. Treasury bond, which is kind of like the gold standard for a risk-free investment.
Backed by the full faith and credit of the U.S. government.
Exactly. And this yield spread, or cap rate spread as Michael calls it, is basically the difference between those two rates. It represents the extra return investors are hoping to get for choosing real estate, which carries more risk than a government bond.
So let's say a property has a cap rate of, I don't know, 6%, and the 10-year treasury is yielding, say, 3%. That means the yield spread is 3%.
You got it. That 3% represents the premium investors are seeking for taking on the additional risk of real estate compared to that super safe treasury bond.
Ah, I see. So it's like a quick and dirty way to assess whether the potential reward justifies the risk you're taking.
Precisely. It distills this complex risk-reward calculation into a single, easy-to-understand number. And Michael says that number can be incredibly revealing, especially in a market as dynamic and diverse as Chicago.
So besides just helping us understand the risk-reward equation, why else is yield spread so crucial for investors, especially those navigating the Chicago market?
Well, Michael points out that yield spread can actually be a powerful indicator of the overall market health. And that's super valuable, especially in Chicago, with its unique mix of neighborhoods and property types.
Okay, so how does yield spread help us take the temperature of the market?
For example, if you start to see a narrowing yield spread, meaning the gap between cap rates and treasury yields is shrinking.
That could be a signal that the market is getting a little overheated, right?
Yeah. It might mean that real estate prices are getting inflated, or that investors are pouring in despite lower potential returns compared to those bonds.
So a narrowing spread could be like a little yellow flag telling us to proceed with caution, right?
Exactly. It's a sign that things might be getting a bit frothy, and investors need to be extra careful about not overpaying for assets.
Makes sense. So it's not just about evaluating individual properties, it's about understanding those larger market dynamics too.
Precisely. Michael always stresses that being in tune with those market cycles is essential for making smart investment decisions.
Okay, so we've got the theory down. But how does this yield spread analysis actually play out in real-world scenarios? Can you give us some examples?
Definitely. Michael often uses a few key scenarios to illustrate this point. For example, let's say you're considering investing in distressed commercial properties, maybe in a neighborhood that's undergoing a bit of a transformation.
Okay, got it.
Now, if the yield spread in that area is relatively large, it could indicate a really interesting opportunity.
Why is that?